We are live? Yeah. Somebody just not care. I'm done. Okay. We're going to start today with Carl Davis, who's Research Director from the Institute on Taxation and Economic Policy. And we're going to get another, I'm sure, uplifting presentation on federal tax and budget bill and the impact on Vermont. So we had some of this earlier this week and get some more. And Bill, yeah, Carl, come on up. We just ask you to introduce yourself to the record and then maybe tell us a little bit about yourself.
Absolutely, I can do that. For the record, I'm Carl Davis, Research Director with the Institute on Taxation and Economic Policy. I'd like to, of course, thank the chair and the whole committee for making time for me today. I'm very glad to be able to share some thoughts on the federal tax bill and what the implications are for Vermont. Also, just very excited to be here in Vermont in general. I really do love this state. I'm not pandering. I actually lived here for almost 3 years. 2.5 tax years, 2 resident returns, 1 part year return. I was here for two falls, but 3 mud seasons. So I feel like I should be allowed to round up to 3, but yes.
You got our best and our worst.
Yes, I saw it all. But it is a great state, and to talk about taxes in Vermont, it's a dream come true. I am going to share my screen. I do have a slide deck, and I'm going to be. I did a version of this testimony in Ways and Means this morning, and I'm going to skip a few slides along the way, so you can go back to those if you would like. But I'm going to try to be respectful of your time and not drag this out more than I need to. But anyway, for those of you who aren't familiar with ITEP, we are a nonprofit research organization. We're a national organization based in DC. We have separate policy teams, one dedicated to federal policy, one dedicated to state, and one dedicated to local. Our state team is our largest team. That's historically been our organizational focus. That's where I spend the bulk of my time. I think that's just the most interesting part of the work. We're very much a research data focused organization. The vast majority of our staff are analysts of some kind or another. We don't have as much expertise, say, on the legal side of things. We analyze a lot of data, produce a lot of numbers, and I'll be sharing some of those with you today. But this shouldn't be it's not too numbers heavy of a presentation. Well, if you don't think I live up to that promise, you can tell me afterwards. All right, HR 1, the One Big Beautiful Bill Act. I know that you've had some presentations already on what was in the bill, so I don't want to rehash every little provision. Just a little bit of a refresher on the major aspects of it. It was a long list of different kinds of tax cuts, a somewhat shorter list of different types of tax increases to partly offset the cost. We saw reductions in tax rates, changes to the brackets. The QBI business income deduction, that's to pass-through businesses that aren't traditional C corporations. The standard deduction was increased. The child tax credit was increased. There were these new blockbuster deductions added that even people who care less about taxes than the folks in this room have probably heard about around tips and overtime and car loans and so on. A large number of business tax breaks as well, a lot of them related to depreciation. On the tax increases side, personal exemptions are now permanently repealed from federal law. This SALT cap has been made a permanent feature of federal law. That's a $10,000 cap on how much state tax you can write off. Temporarily increased to $40,000, and then it's supposed to snap back to around $10,000. Some of the a lot of the green energy provisions, tax credits for renewable energy and so on, enacted in 2022 were either repealed or significantly curtailed in the bill. So those are some of the offsetting changes. Let's skip that slide. So what does this mean? We maintain a tax model that is capable of disaggregating the distributional impact of these changes in every state. Distribution is how are folks in different economic circumstances affected. On the panel on the left, this is expressed relative to income, a very common measure of how families are actually impacted relative to their household budgets. What we see is a regressive tilt in the federal bill. All regressive means is that the tax cuts tend to get larger as income rises. They get larger relative to income as income rises. So that's kind of textbook definition of regressive in public finance. And then you can see what that means in terms of actual dollars on the right panel. So this was a tax cut across the board, but the impact was not even across the income scale. It was around $100 a year for low income earners, about $2 a week or so in their paycheck. For middle income earners, you're looking at maybe $1,000, $2,000 a year, it depends. And then from there, it keeps increasing to tens of thousands, or we actually have another slide in the deck that you can look at that has very similar findings from Congress's official Joint Committee on Taxation. They analyzed it nationally, and you can see in their findings that by the time you get to the top 0.1% of families or so, you're looking at hundreds of thousands of dollars in tax cuts each year. So that's the distribution of this. I don't think this is tremendously controversial. This was analyzed both by Congress's scorekeepers and also by outside entities like ours, and they generally find the same pattern. But these are our Vermont specific analyses. And as far as I'm aware, we're the only organization that's done a Vermont specific analysis. So one thing I'd like to point out about, how should we feel about the distributional impact of this bill? And then that's not something I can tell you. There was, I think, a very informative poll done by Gallup 3.5 months before the bill was signed into law, and they were asking folks of the American public in general, nationally, not specifically in Vermont, how do you feel about the tax level being paid by different sorts of families? And you saw relatively majorities, not relatively narrow majorities of people saying that low and middle income people were paying too much. As you saw, the bill had some tax cuts for low and middle income people, more in the middle than at the low end. The low end tax cuts were quite small on average for working class low income families.
Just so I'm reading this right, it's not low income people are saying I pay too little, I pay my fair share, or is it just the broad I get pulled and I say lower income people pay too little, fair share too hard.
Precisely. Yes, thank you. That's a good clarification.
Okay.
Thank you. Yes. So, most of the public feels that low income people are paying too much. At the high end, we see a very, very, very different takeaway. So you had in March of 2025, around 12% of the public saying that upper income families were paying too much. And then you have 4 months later, this bill signed into law that included very significant tax cuts for upper income families. So that I think this points toward a disconnect between what was contained in the bill and what the public has been saying they're hoping for in tax policy. I think this is potentially relevant for you as state lawmakers. If you're seeing this kind of disconnect at the federal level, it's natural to ask, well, what can we do to help steer tax policy back in a direction that better reflects what we're hearing from folks about the level of taxes different groups are facing. And then you can see on the corporate side, especially, there's almost nobody in the public who's saying that corporations are paying too much in tax. And there were significant tax cuts for corporations in the bill. And then these are some of our data at the bottom of the slide, fleshing out exactly where the tax cuts are flowing, and just to emphasize, around half of the tax cuts in this federal bill are flowing to the top 5% of families nationally. That's around $360,000 or more of income per year. So the Vermont context, I'm going to pivot now. Gradually pivot to talking a little bit more about Vermont, what this means for Vermont. This is our analysis of what Vermont's tax code looks like, again, expressed relative to income. And what we see is that Vermont has a tax code that is progressive through about the bottom 80% of the distribution. And for low and middle income families, you can see that upward progressive slope where taxes are rising alongside income. By the time you get to the top 20% of that or so, the Vermont tax code is actually relatively flat or slightly regressive. You see this tailing off in the effective tax rates, where high income earners are not paying meaningfully more, and in fact are paying slightly less than some of those middle class and upper middle class families relative to income. So again, if you're thinking about what's the role for Vermont tax policy in the wake of significant federal tax cuts, which I showed in this previous slide, about half of them were going to upper income earners. I think this is a relevant piece of context to have.
Question.
Yes.
Do you have that broken down in terms of income tax and property tax and?
Yes, I do. If you go to whopays.org.
Yeah.
Yeah, it's disaggregated in about 9 different categories.
Right.
Okay, and this is total taxes, not just income.
Precisely, yes.
Okay.
Income, sales, property, excise, all these levies. So I think we have around, in a typical state, around 98-99% coverage of all the different taxes levied.
That was my question from your earlier slide. I'm sorry, I should have asked it then, but about the OBBBA impacts by income level. Is that all taxes or just income taxes?
That's all taxes. Overwhelmingly, that's the changes were on the personal income tax side. The corporate income tax was secondary, and then estate tax after that. And the estate tax did change modestly.
Okay,
The federal government doesn't have the same array of taxes Vermont has. You have a little bit more diversity in there.
It doesn't include property taxes though.
Correct, yeah. Mhm.
So we're 49th on your list.
Yeah, in level of rigorous.
Does that mean we're very progressive?
The way I describe Vermont system is basically a hybrid system, where I do think you are progressive to the bottom 80% of the scale. If you were looking at like a textbook, like example of progressive, the rates would keep rising alongside income, but you can see at roughly the middle or so of that graph, it kind of flattens out. So it's partly progressive and it's partly proportional to moderately progressive.
I know what we've balanced or tried to, or thought we were trying to in the past. I believe it is the top 20% or 10% paid in 50% of the state revenues. And there's an ongoing discussion about how high can you go with that top tax bracket before you start losing taxpayers, given that New Hampshire with no income tax is next door. You do any data analysis on what is that? We're one of the highest top end, and when our top end starts fairly low, how much elasticity is there before it starts to become, we start seeing declining returns because we lose folks.
Yeah, I can take that in 2 parts. To your first question about, or your first point about, the share of tax being paid by exceptionally high income people. In a lot of states and nationally, that will edge up over time, in part because we're in an economic environment of expanding inequality. And so as the very high income people capture more income and a larger share of national income, a larger share of national wealth, if you have, let's say, a progressive tax code, they're going to pay more tax because they're collecting more of the income and more of the wealth. So that affects it too. Like if we had less inequality, you would also see that share of tax pay come down, even if you didn't touch the tax code at all. To the other point about migration, this is definitely debated and studied in the literature. There's a lot of very interesting studies on it. It's a difficult analysis to do because you're trying to analyze the counterfactual, who migrated for this reason or that reason. And what we see with migration in general is the populations that migrate most tend to be lower and middle income families. Oftentimes it's housing related because housing costs or we've absolutely seen migration in the states with lower housing costs. You have folks trying to put a roof over their head at an affordable price. So that's a factor, but just also lower and middle income people moving to seek out job opportunities. At the high end of the scale with high income earners, one of the nice things about having a high income is that you have more options in where you live. You can afford to live more places. You're not, it's not a question of can I put food on the table, or can I afford my streaming subscription, or you've got your basic needs of life met. And so the calculation looks a lot different for them when they're moving and what matters and so on. So, I mean, I think the literature, we haven't done specific studies on migration, but I think there's a robust academic literature around it. And what it points to is that tax-based moves happen occasionally, but it's not an overwhelming effect in the grand scheme of things. So you can find it in the data, especially in moves to Florida, around which are hypothesized to be a mix of tax effect and climate effect. But outside of Florida, there's not like a groundswell of people moving to South Dakota or anything like that. It points toward a nuanced picture of it not never happening, but it not being at as large a scale as some of the discussion points toward.
I was just gonna add to what you're saying. I know I heard that when Massachusetts did their millionaire tax, they didn't actually see an exodus of people. And it's funny because that's not what we hear anecdotally in the state of Vermont. Like every time we try to do this kind of work, we get pushback because there's this sense that people are going to leave. But to your point, I just don't think the data bear that out.
Yeah, I think that's accurate. The Massachusetts millionaires taxes raised more revenue than they expected.
But I'm told their millionaire tax is only 0.25% higher than our top bracket. And our top bracket starts very low. They have a 5% flat tax. So lower income people are paying significantly more in Massachusetts. I think we're at 3 something. And dual professional families are paying that same tax bracket pretty close to that same tax as billionaires in Massachusetts are paying. I have 1,000 billionaires.
We have a $340,000 tax.
Yeah. I mean, it's,
Yeah.
so we've got a very different taxing structure.
I do believe our data bear out that Vermont has lower taxes for, say, lower income and working class families than Massachusetts does. A lot of that is the progress that's been made around some of the refundable credits.
So even without, even with the refundable, we do a lot of those too.
Do you have any situations in which you have seen a state put on a significant revenue increase that affects higher level people? You have the Massachusetts example, which is somewhat nuanced because of that 5% to begin with. But have you seen any other state do what we time and time talked about of increasing the taxes on the wealthy in order to derive revenue, and what the effect of that is that you can point to specifically?
Well, the most recent example of one being implemented, I believe, is Maryland last year. There were both increases in the creation of a new top income tax bracket in general, and also the addition of a surcharge specifically on capital gains. So that was two-pronged in Maryland. That was implemented last year. Before that, Washington State comes to mind. They don't have a broad-based income tax, but they created a tax specifically on capital gains. And the governor, in the last month, 6 weeks or so, has come out in favor of creating an income tax specifically narrowly on the top 1% in Washington State. I believe also today, Rhode Island's governor, the reporting was indicated he was going to release his budget proposal, and it's going to include a 3% addition to the top Rhode Island tax bracket for, again, calibrated for the top 1%, which I think they were estimating around 600,000 or so a year of income, or maybe slightly more. And I think that's a particularly notable example because this is a change for him. This proposal has been circulating around Rhode Island for several years. He's been opposed to it, and he's come around to this lately in part in response to what's happened at the federal level. Both, number one, the significant federal tax cuts for high income people, but also the spending reductions that are going to flow through to Rhode Island some of the extra challenges Rhode Island's gonna face around funding SNAP or healthcare and so on. So he's actually changed course on that. And I believe that budget proposal came out today. I haven't been able to look at it yet, but I will look at it next week for sure.
And the real question is, what is the effect on the economy to population loss for tax increases? And so, for example, if you have a state that has relatively few millionaires or billionaires, and the amount that those people pay in taxes in the existing system can change if there's significant increase in taxes focused on the wealthy. And the question is, how much revenue do we lose on average when something like that happens compared to the amount of revenue we lose from the people who make $38,000 per year?
You know, I'm not aware of any evidence of any high targeted increase on high income people actually leading to a loss of revenue. I mean, on net, you know, there might be a modest.
Does anybody measure that? In other words, measure and report on it on a consistent basis. Is anybody looking for that as an answer, as a question that needs to be answered?
I mean, I think it's there's some, yeah, I mean, there's some literature on that, and the effect is generally kind of small. That it's not, you know, it's nuanced. You can't say the effect is zero. If I sat here and told you no one's ever moved your tax bill, that wouldn't be true. But I think the effect is small enough that these proposals end up being significant net revenue raisers on the whole, which I think is what the Massachusetts example illustrates. For example, they have seen a significant uptick in revenue since
The thing I would worry about is just the optical illusion, which I don't think is an illusion that I've seen. I had a property in Florida that I had a political event for when I was running for statewide office, and I compared that to the events that I had in Vermont. And I raised much more money in Florida with the relatively few people, quote unquote, who had moved to Florida, because there were a significant number of Vermonters who were in Florida who spend 6 months in a day. And just the question is, how much money do we lose when that happens? Compared to how much money do we lose when we lose a $38,000 a year person? And how many of those $38,000 a year people do we have to lose to equal one of those people who leaves?
That might be.
And is anybody tracking that?
Yeah, that might be a question for the tax department. Yes, because they would know when you filed here and when you didn't file next year. But someone would have.
They don't know necessarily where you went.
No,
In other words, we pick up the people who move in and we measure that, but we don't pick up what happens to the people who leave. There's no measurement that I've seen that does that.
You all.
well, that it's not you, Paul. The statistics I've seen was American Van Line.
Yeah, right.
Yeah.
Was
Yeah.
one of the, which is one class of families that
Yeah.
can afford an American Van Line, not. I've never moved. We had a roofing truck once, but never moved with a van line. Did a lot of U-Haul. So I do it. I saw Senator Hardy. And then
Yeah,
we're gonna move along here.
Yeah, I was just gonna say, I mean, I think as our guest said earlier, there's not research that shows that the effect of higher income people moving out of the state when taxes change. There's not a lot of evidence that happens. There's more evidence that people of moderate or lower income are more mobile because they're moving for jobs or housing or whatever. And so I think that your example, which, you know, obviously is just a one-time anecdotal example, is just because a lot of the people who move to Florida or spend part-time in Florida tend to be older. And once you're older, you tend to have more means. Your income tends to be higher. My income is higher.
Sure.
My family's income is higher now than it was 30 years ago, just because of.
Mine was too before I joined the legislature.
Yeah, exactly. That's why I stopped when I said mine. Well, it's not really vegan. But that's the, I think it's, you know, and I can try to find some articles, or maybe you have some suggestions, that there has been research done on this, and the impact is, that's not there.
I haven't seen a whole lot of research, and that's why I asked the question, because it's research that I'm certainly looking for, because it's a question that we get asked over and over again, and it would be good to have an answer that we were comfortable with.
And I think there was some academic research, but it may take some digging to find it. And I think we've demonstrated why I have banned this discussion in this committee, because everyone has an opinion and no one. But it is a subject that comes up regularly when we talk about any kind of tax increase or decrease. And the fact
Tax
is that
Foundation
there's
for another side of viewpoint would be one organization that I think has a slightly different viewpoint. And again, which is right, I don't know.
I mean, there's opinion on both sides.
So I'm gonna move on to talking about.
That would be good.
Okay, the other, what you were asking specifics, one, I know some of the academic, one author to look up is Cristobal Young. He's an academic. Cristobal, C-R-I-F.
Cristobal.
Cristobal, C-R-I-S-T.
DOL.
OBAL.
O-B-A-L, thank you. Cristobal Young. Yes,
Young.
yes, and the reason I mentioned him specifically, he's done some work with confidential IRS tax return data, he's an academic researcher,
Mhm.
and you can do such a higher quality analysis with that. With that sort of-
Barely bad months.
Yes. So, but there are other papers too, but I know he's done a lot of work on this. Okay, so conformity, this is how you link up to the federal tax code. Large scale conformity debates are kind of like they're like the cicadas, they show up every 8 years, every 10 years or so. You have to deal with one of these things. The federal government passes a lot of tax changes. You have to think about how many of these do we want to go along with? How many of these are we going to pass on? And I would definitely encourage you to look at them on a case by case basis. And our recommendations around this aren't toward, pure conformity to everything, but they're also not toward pure decoupling from everything. I think there's a middle ground that would point, that would be the right balance.
I think we did a lot of that after the first tax cut jobs bill,
Yes.
where Vermont made $30 million from middle class Vermonters. And so we did rewrite the personal income tax code. We may need to look at that, but it sounds like it may be the corporate tax, which we just rewrote 3 years ago, where we may be seeing the biggest hit this time. And since Ways and Means did the bulk of the work in rewriting it, and it's a revenue bill, they will be doing that this time, and then it will come here.
Yeah, you're exactly right on the move from, the states, a lot of states have gradually moved toward being a little less closely linked up to the federal tax code. Several decades ago, it used to be a lot of states.
We were totally tied. It was
Yes.
a percentage of your federal tax liability.
So that's as close you can get, because then any change Congress enacts at all can impact the state tax bill. Then you move one step less linked up to moving the taxable income. Now you're even less linked up with AGI, which is the sweet spot, I think, where most states have landed now. That's the norm. And so,
Just before the last tax cut bill.
yes. And I think personally, I would be grateful for that. I think that was a smart thing to do. I think that's the gold standard in the states. And it means that a lot of these blockbuster new tax changes aren't going to automatically impact you. You're not automatically offering a new deduction for tips or car loan interest and so on. And I think that, these are not especially beloved among the tax policy community. You mentioned Tax Foundation earlier. I don't think if you brought them in here, they're not going to express a lot of love for these items either. So I would largely encourage you passing on these kinds of things. That being said, I think there are some things in the bill that actually move things in the right direction. There were some modest improvements to the dependent care credit and also the flexible spending accounts that folks use to pay for dependent care expenses. We know that childcare is tremendously expensive in this country, and some of these credits and FSAs were due for an update. And I think those were expansions that have some policy merit, and there's a simplicity benefit there to you of going along with those sorts of changes. There are also some business side changes related to how international taxation is administered. And so there are some things in there that I think were worthwhile. What I'm hoping to focus on for most of the rest of my slide deck are some of these items where I think they're worth putting under the microscope and thinking, and part of the reason I think you should put them under the microscope, there's a couple levels here. First, you have to ask, was this good federal policy? Was this good tax policy at the federal level? Was this a mistake or not? And then separate from that question, you ask, okay, if it made sense at the federal level, does it make sense for Vermont? Because sometimes there's a translation problem where just because something makes sense in the federal code, you might not get a lot of benefit out of it for your state from administering this kind of thing. And I have some examples that I'm going to walk through specific to that point. And the other thing to think about, just, you know, I mentioned we've seen a lot changing at the federal level lately. Just briefly, we've seen a lot of cutbacks at the IRS, very significant historic reductions in IRS funding. Some states are thinking now about what does that mean for tax enforcement in general. If you're linked up to the federal tax code in any way, if the IRS isn't monitoring that AGI definition quite as close as it used to, that could be bad for your state too. So thinking about what you should be doing with tax compliance, if there's any way to fill gaps being created by layoffs at the IRS. And then to the point I was making earlier about Rhode Island, I think part of the Rhode Island governor's pivot on this topic has been an explicit response to the federal tax bill. So thinking about beyond just conformity, I'm going to focus most of what I have to say here about conformity. But is there anything happening federally that would change? You know, if it's the tax cuts at the high end, if it's the spending reductions impacting budget, is there anything more generally that would change what you'd like to see in Vermont policy? So this is one that you are conformed to. This impacts AGI, administered as an exclusion, and this has been around since the 90s, and it's flown under the radar until very recently. It started off as a very, very small tax break, ostensibly aimed at small business, so most people were, you know, in favor of it and didn't pay a whole lot of attention to it. And what's happened over the years is this has gotten much larger than people realized. I was at a Treasury conference in fall of 2024, where some economists there presented data on this particular tax break, and it just blew away everyone in the room about how large this thing had gotten. We had no idea because it's administered as an exclusion. The IRS data around this aren't particularly robust. You don't get this in the normal IRS data tables every year. So this is a special one-off study they did on the size of this. What this is, it's a tax break for early stage investors, basically in tech companies. And the reason for that is there's a lot of industry carve outs. You know, if you're running a restaurant, if you're running a hotel, if you're running a farm, you're flat out not eligible for this. You have to be in certain industries. You have to be organized as a C corporation. So a partnership, a sole proprietor, you're not going to get it. And it's early stage. You have to get the stock directly from the company. And it has to be a company that at the time you acquire the stock is worth, used to be 50 million or less, now 75 million or less. This is being expanded. And this is siphoning off around 2% of all federal gains tax revenue without anyone knowing it until about a year ago. And I think I have some, if you want to look at my slide deck afterwards, I have some quotes from a range of organizations expressing a lot of skepticism about this federally. It's tremendously complicated. It's extremely regressive. 94% of the benefit is going to millionaire households, not millionaire wealth, households with more than $1 million of income per year. And it doesn't translate well to Vermont in the sense that there is no mandate whatsoever. And you couldn't, as far as I'm aware, create a mandate that these companies be located in Vermont. These aren't Vermont-based tech companies. This is for an investor likely investing in a company in California or in Seattle or so on. There's no in-state targeting here. So whatever rationale there is for it federally, which is pretty disputed, that is significantly weaker at the state level. This has been, it's expanded in the federal bill. The information you get from JFO, which is accurate, is that there's not a big immediate revenue impact to this because the expansion takes time to take effect. It's for newly acquired stock that you have to hold for a certain number of years. So it takes a few years for the expansion to have effect. But this is drawing a lot of attention now because the break itself that was already on the books before the HR1 expansion was a lot larger than people realized. And so we just saw DC a month or two ago decouple from this. basically using HR1 as a wake up call and saying, wait a minute, we have this thing in our code. What are we getting out of this? Do we really want to do this? And they decided to decouple before that. And I'm expecting we will see more states decouple this year. But before that, states that were already decoupled were Alabama, California, Mississippi, Pennsylvania. So, I'm not, again,
Can I make sure that I understand the effect of this?
Yeah, please.
When the state decouples from this, it means that that revenue can be taxed at the state level.
yes, you add back that income. This is
All right.
income that's missing on the federal forms.
Yes.
It's income.
So you add that back in on the state form and then the state can tax it.
You're broadening the tax base for bringing
Now,
that
the
in.
question is, what effect does that have on the resident who is sitting in a state that does not have that does not have that decoupling? Does that encourage that person to leave that state and go someplace else? Just as if they were going to a tax-free area, it can have the opposite effect.
So you have a 0% tax rate on this certain type of capital gains.
Correct. Unless it's
Right
decoupled.
now. Yeah. I mean, I think that is the exception rather than the norm. I don't.
Has anybody measured that?
Well, California, the background, the most robust discussion of, if you want to look at the legislative record, the most robust discussion of this has occurred in California. What happened in California was they have a lot of these venture capital investors
Mhm.
and they were losing a lot of revenue. And they said, wait a second, it turns out that a lot of these investors are investing in like Utah companies or Washington companies. And why are we offering a tax break on this? So what they did was they tried to say, okay, we're only going to offer this tax break for investments in California companies. And it got struck down in court. And because that's discrimination against interstate commerce. And so they said, you know what, this isn't worth it for us at all. If we're offering a large windfall of these out-of-state investments, we're not going to do it. So if you wanted to look at the, I guess the shorter answer to your question is the migration literature in general doesn't point a lot to a lot of these tax-induced moves. If you're looking for literature around this specifically, I would look to California first because they've debated this most robustly, and then there's also the Treasury Department study that.
Well, I would think that anybody, that a wealthy person, as a general rule, has tax counsel and has probably pretty good tax people. And that would be one of the first things that I would certainly look at. And I would say, I have a company that is likely going to be extremely successful based on where it is right now. And I see that a bill comes up in the legislature that would penalize me by taxing a substantial amount of income that I now have. I would be thinking, very seriously about where can I put my tax home because it's movable.
So there's an interesting story in the New York Times lately where they were interviewing a lot of accountants who were working with high net worth clients and were thinking about what to make of the proposed higher brackets in New York City. And then a lot of clients came to their accountants and said, "Oh, rates are going up. We think we're thinking about moving." And what these accountants said is, for every person that comes and floats that idea to them, for every 10 that come and float it, at least 9 of them don't end up doing it, because it turns out what often the first reaction to that is from high net worth people is to try to move the money. So they'll say, okay, I'm going to park it in a trust, or I'm going to not really move. Let's say I moved and did that sort of thing. And those are the kinds of things you actually can address through policy intervention, making sure that you have tight laws that are governing, how trusts are taxed and how easy or difficult it is to move money into a trust and just sidestep paying state tax, or your enforcement of residency rules about how long someone's going to be in the state to pay tax and that sort of thing. I think taking that enforcement seriously, because that's usually the first thing that high income people are looking to do when they see a change like this. They say, how can we avoid our way out of this? And if you make it too easy, they will. But there are measures that can be taken to have more robust enforcement on these questions.
Gonna have to.
Okay. All right. What time are we shooting for?
We've got about 7 or 8 minutes, but Kirby, what's your schedule like?
You can run over. Don't worry about me. Well, I'll speed it up. So on
It's not you.
On depreciation, you've seen in the JFO scores likely that these are the largest business tax, the largest tax cuts period from conformity. So worth being put under the microscope for that reason alone. And again, this is a similar theme of a lot of my remarks that whatever the rationale federally is, we're definitely advanced federally as economic development tools. That rationale does not translate as well to the state level because it comes out of pre-apportionment income. So what that means is if you are offering a tax break for a certain kind of investment, you're going to have to offer it across the board, whether the investment is in Nevada or Oregon or not. So yeah, so for that reason, we have seen, and there's an article from Michael Bologna and Bloomberg earlier this month running down some of the decoupling actions. We have seen some states decoupling from this because number one, like I said, it's the largest revenue loss of all of the conformity items. And number two, they're worried about it not being especially targeted to growing that state specific economy because it's a broad tax cut for investment anywhere. So one of the flag that. The other thing, my third bullet point here, what this is in reference to is there are certain parts of the depreciation breaks that are for investments that already occurred. I would consider with the way time works, it's impossible to incentivize something that already, it's impossible to incentivize something that already happened. So I would be especially skeptical of that.
Yeah,
Okay. International is the other area I would really take a close look at. We've seen confirmation now twice from at the federal level. First in 2017 with TCJA, again in 2025 with HR1, that if you're administering a corporate income tax as you are and as the federal government is, you can't put on blinders and tune out what companies are reporting internationally. At the federal level, these profits that are being booked internationally are coming into the tax calculation through things like NCTI and Subpart F and so on. You have to be attuned to this because if you're not, what we see again and again and again across a wide range of literature and just the practical experience of practitioners is that if you're not paying attention to what's happening internationally, companies claim that they're earning just huge and outsized shares of their profits in foreign tax havens. You know what I mean? You say, where did you make your money? Oh, no, not in Vermont. We made this money in the Cayman Islands, this money in Switzerland, in zero tax places. This is not really a controversial thing. It's pretty well documented that this is going on. That's why the federal government has some of these provisions that I think are worth thoughtfully coupling to. And that word thoughtful is the point of my second bullet here, which is that you also need to be aware that your corporate income tax, the foundation of it, is meaningfully different from the federal corporate income tax. The federal level is basically a worldwide system with these partial deductions and with foreign tax credits that are designed to help tax the right amount of income. In Vermont, you're using sales factor formula apportionment. And so that's what I'm going to walk through this sales factor quickly, because I think to understand how you should link up to the federal international provisions, you have to understand how the sales factor works, because it's fundamentally different from the federal code, and it definitely impacts what makes sense as logical principle policy in Vermont. So a very simplified example of how a company pays tax under single sales factor apportionment. Let's say you have a company with $1 billion in sales. They're making a 10% profit. That's a $100 million profit. Vermont doesn't get to tax all 100 million of that. That's not the goal of Vermont's corporate income tax. You're going to tax your appropriate share of it. How do you determine what the appropriate share is? You could ask the company. What will probably happen is they'll tell you, they made most of their money in Nevada and, not in Vermont. So what's happened over the years is states moving toward a combined reporting formulary system where you say, okay, put aside, the accounting structure that you've come up with for your business. What is the economic reality? Where are your customers located? If you don't have customers, you don't have a business. So they know where their sales are. They know where the money is flowing in from those sales. So let's say it turns out this company makes 5% of their sales in Vermont. That means Vermont is allowed to tax 5% share of that $100 million pie. So that's the way that the system works. When it comes to the international income items, the goal of bringing international income into the system is not to raise taxes on these companies. It's to make sure you have a more thoughtful, enforceable calculation of what they should owe. And so here's an example of that. Let's say now, instead of only looking at the same company's US profit, let's look at their worldwide profit. They're making a $200 million worldwide profit in this case. Off of two billion in sales. Well, your sales factor is now shrunk. Now Vermont doesn't get a 5% share anymore if you approach the math this way. You only get a 2.5% share, but it's a 2.5% share of a larger pie. And you can see that this, you end up taxing $5 million of profit either way. So whether you're bringing a broader international view or a more myopic, domestic view to it, you end up with the same slice of the pie, the same amount being taxed in this case. And in this simple example where you don't have any kind of shenanigans going on with the profit shifting and so on. And then just really to hammer this point home, and this is going to be relevant to I'm going to have a more practical application of this on the next slide. Let's say this company expands its overseas sales. Now it's got, another 500 million in overseas sales, another 50 million in profit. Your sales factor is shrinking even more. Now you're only taxing 2% of this company's profit. And yet, even so, your tax base is $5 million in all these cases. And what this emphasizes is that the point of sales factor apportionment in Vermont is to make sure you're not trying to tax overseas income. That's not the goal of this. You have an example of a company here that's expanded its overseas operations and its tax bill doesn't change at all because that's not what you're trying to tax. You're trying to tax what's happening here in Vermont. And so the reason this matters, again, the federal government doesn't do this. You do, almost all states with corporate income taxes do, federal government doesn't. And what the federal government is doing instead, it used to offer what was called the FDII deduction. Now it's been renamed FDAE. I don't come up with these acronyms, I'm just a messenger. What this is, it's a category of income, basically income that U.S. companies are generating from their export profits. So you have companies exporting, and what the federal government says is, okay, we like exports, we want to offer an export subsidy, and we're going to let you deduct around a third of that income from your federal forms, and then we're going to tax the rest. We're subject to foreign tax credits to prevent double taxation, but it's pretty explicitly trying to tax these profits derived from exports. Your system in Vermont is already calibrated not to tax exports. You're not trying to tax exports. As the previous slide showed, we had a company dramatically expand exports, and its Vermont tax bill didn't change by a dime because you have sales factor apportionment based on where the customers are located. By definition, if it's an export, the customers aren't in Vermont. So the point of this is that really the FDAE deduction makes sense federally, arguably, but in a single sales factor apportionment environment, you're already not trying to tax exports. And so because of that, we've seen a lot of states decouple from this. And I have Colorado is the most recent addition to this list. These are the states that have decoupled. Colorado decoupled in August, just a few months ago. I think that the green states here have decoupled. I think you would see the reason that this map isn't even more green than it was in part with the way that the TCJA changes went down. They were signed into law in December of 2027 or 2017, took effect January 1st, 2018. And I gotta tell you, I was following this at the time, and it was wild. And I'm sure a lot of you were as well. People were trying to make sense of this. It was hard to understand what was in the bill federally, much less what the implications were for states. And so there wasn't a lot of decoupling from FDAE right in the immediate aftermath of the enactment of the 2017 law. And I think one lesson from this is why I think it's especially important to take conformity now. It's take conformity seriously now, is because the decisions that tend to get made in that first legislative session following a big federal bill, there's a momentum to them. You can change your link up to federal law at any time, but oftentimes those decisions made in that first session tend to stick around. And I think that's why this map looks the way it does. It's because there was so much confusion in early 2018 about what these things really meant, what they were going to do. Ultimately, the JCT scores around this provision ended up not really reflecting reality either. There was a lot. Everybody was very scrambling to wrap their heads around these things. Okay, and this is my last topic. If I have time,
just ask just one more question. In terms of states that are making a decision based on this,
Yeah.
Is it because of where is it because of where the sales occur by state as opposed to nationally?
Why a state would choose to decouple?
Yeah,
All of these states use formulary apportionment, and 98% of them use sales factor formulary. So you're all coming at it from pretty much the same starting point.
is that formularity based on simply an algorithm, or is it based on the fact of sales?
Yeah, it's based on the location of the sales.
Okay.
The formula used to be more nuanced and considered where property was located, where payroll was located, and so on. And that's been largely abandoned.
Okay.
So I don't think it's really tax policy differences. You're all starting from very similar foundations. So I would say the momentum is gradually moving toward more decoupling, and I think we'll see. This is, anytime a federal bill is enacted, it sparks debate, and I expect to see what change.
Is it relatively easy, or is it difficult for a state to model what would happen if it decoupled?
I was actually just talking with Pat Titterton, JFO, about this, so they are looking into that. It is helped by the fact that these are federal income concepts, so we have federal tax return data. So we're not, you're not talking about bringing some unknown into the system, filling out detailed federal forms that you can run. But the calculation is complicated by the differences between the federal and Vermont code. So I believe that JFO is working through this, but I can't speak for them. That's wrong. I apologize.
Okay.
So the last concept I wanted to cover, I'm going to skip this slide. So this will be my last slide. The other thing to keep an eye on federally is NCTI. This is a nested acronym. We have an acronym inside an acronym here. Net CFC tested income, net controlled foreign corporation tested income.
Never guilty.
It's the new guilty. And there's a debate about whether we should pronounce it NICTI or necktie. I'm firmly team necktie myself, but everybody's got their own view of that. What this is, it's another category of corporate profit, and this is a totally different category than today. By legal definition, there's not allowed to overlap at all. This is the profit that foreign subsidiaries of U.S. companies are booking abroad. And what that is, it's a mix of legitimate foreign profits. You have U.S. companies with a foreign arm and making real sales, making real money overseas. And it's also a mix of these shifted profits where companies are saying, we earned our profits in Bermuda, we earned our profits in Singapore, that kind of thing. So it's a mix of both of these. So it's not appropriate for Vermont to try to tax all of this. You don't want to tax legitimate foreign income. The federal government is not trying to fully tax this either. They've historically allowed a 50% deduction for this income. That's was reduced on January 1st to 40%. So they do a partial taxation of this, and then they apply foreign credits. Vermont, again, the goal of your system is not to go out and tax all of this income. You have single sales factor, which helps you isolate which part of any pool of profits. And again, I had that, that 3-step slide earlier where you saw Water's Edge and Long Line and so on. No matter how big the initial pool is, if you grow the pool, you're going to shrink your sales factor. The goal is to tax the appropriate share. In Vermont, instead of going out and taxing 50% of it or taxing 60% of it, you have single sales factor, which helps you identify what part of all this profit is really attributable to Vermont, because that's where Vermont customers work. And so I think the federal deduction is serving a different purpose at the federal level of trying to reduce taxes on this category of profit. And it doesn't serve that same purpose in Vermont because you're already taxing a percentage of this profit built into your sales factor. You don't have to write a percentage into the law and say 40%. You already are taxing a percentage.
Is it, with this one and the previous one, is it mostly to make our statutes, our corporate income taxes cleaner? Because it doesn't, at least in your example of the other one, it didn't change the amount. So it's not about the amount, it's about the cleanliness or the ease of calculation.
Practically rubber meets the road. You're looking at, you're appealing to deductions. if you were to do this, you would repeal the 250 deduction per day and repeal the 250 deduction for necktie.
Right, so it's basically simplifying our tax code. It's not about changing revenue necessarily, because we're still just taxing the sales in Vermont.
There would be a revenue implication to it.
Oh, there would, okay,
JFO would be able to sort that out.
okay,
But that's not the primary motivation of it. And this is more taking these federal concepts, and I think there's value, and especially with necktie, this is a federally defined thing, audited by the IRS. We know what these amounts are, and being able to piggyback on IRS audited things is useful for the state. Starting from that and then translating it into something useful for Vermont. And so, you start with you start saying it's federal, you start with necktie. But the question is, do you lop off 40 or 50% of it, or do you not need to do that because you're already on taxing a percent via the sales factor?
oh, I see, so you're suggesting just decoupling from the deduction itself, not from the whole concept of
Exactly.
necktie.
Yes. Right. Yes.
Okay.
So you already are bringing necktie into the code.
Uh-huh.
The question is it appropriate to allow this 40% write-off? Or it's 50% now. If you just do a vanilla coupling to federal law, that 50% deduction will shrink to 40. I think the tax policy principles would be, wait a second, why are we writing percentages into the law when we're already taxing the percentage by virtue of the sales factor? We can rely on the sales factor to help line up our tax with economic reality.
Got it, okay, thanks.
Okay,
And yeah, that's all I have. But again, thank you very much. If there are any other questions.
thank you. This has been helpful. It will take a while to digest it all. Which is, I do remember guilty. Necktie is new. But I know JFO is working on this, and I know Ways and Means is working on this because it's revenue bill. But they also rewrote our corporate tax structure maybe 3 years ago.
Mhm.
So they are very familiar with the ins and outs, and we'll see what they send us and then we'll work on it. But it gives us some good things to be aware of and to look for, things I hadn't done. Committee, any last questions? Okay. Thank you.
Thank you
Are
very
you
much.
leaving today?
No, I'm getting on Saturday.
Oh,
I have a little fun before I go. So, and I should be skiing tomorrow.
why
Oh,
not?
jeez.
Maybe it snowed in on Saturday and Sunday.
Is that what they're called?
I think this, my thing this morning said snow. I don't know.
Oh, don't say that.
Yeah. I gotta take a closer look at that.
Yeah, but enjoy skiing.
Thank you.
Okay, yeah, we get to see Vermont at its best. This is not its best, but it is supposed to be cold by tomorrow.
I didn't notice that.
Okay. So we're going to move on. Couple minutes late. We've got an act relating to granulous values of parcels with wetlands, and Heffernan is here and the sponsor, and we just introduce yourself for the record and just tell us what you were trying to accomplish when you did that, and you'll walk us through the word.
Thank you, Senator. Steve Heffernan, Addison County, Senator for the Addison District. S-165, I came up, decided to put this bill forward to help get a more standardized value for the listers to mark on their list. Right now, every town, it says there's not a straight formula to say wetlands. If we can't use it, the other reason started, if we can't use it, we shouldn't be billing out at a very minimal amount, like $200 an acre, just enough to cover administration fees and what have you for the listers to have to do their work and the town to have to do the work. After talking to some listers, they also believe that like wildlife corridors, floodplains, all those areas that Vermont says, hey, this land is not usable because of these factors. that we should find a more a lower price when we go to put it out per acre. The downside is it will affect grand list, but if you can't use your land, I feel for Vermont that it's unfair to Vermonters that they get taxed at rates that whatever the listers decide is what the value is. So Kirby helped construct the bill, and that's my little speech. So thank you for your time.
Okay,
I'm
thank
here to
you.
go back to education.
Yeah,
Thank you all. for your
thank
time.
you. We will take a look at that. Harvey, you wanna? Oh.
Good afternoon. Peter, what's the council? So I let Senator Heffernan know that I'm going to share a little bit of contrary information with you. He's aware of it.
Okay,
Some background. I drafted, I think there's 3 bills floating around right now that valuation when it comes to state restrictions on development in some way or another. I'm going to take some responsibility. I don't think that I informed some people well enough that this already exists. In each case, though, there might be reasons why you want to elaborate on that, and I think that's what this bill ends up doing. This belt and suspenders elaborating on what already exists. So, first, I'll share with you current law, and that's not the current law. See all the fun things.
outside tea fund.
Yeah, all the things that I was doing today. What's that? Right. Yay. This is the definition of appraisal value in statute. This is the starting place that a assessor would start with, but there are chapters that they have to contend with of all the different factors that go into appraisal value. I'm going to highlight part of this. So appraisal value means a lot of things. The estimated fair market value of property is the price of the property that will bring to the market when offered for sale or purchased by another. Taking into consideration all the elements of the availability of the property, its use, both potential and prospective, any functional deficiencies, and all other elements such as age and condition that combine to give property a market value. So when you hear fair market value being discussed in property valuation context, the listers and assessors are already told to take anything into account that's going to affect the value. It's not it's more of an I don't know, maybe this isn't wrong to put it, but the art of science is then you take a lot into it. It's not just a single formula. But specifically, current law says those elements shall include the effect of any state or local law or regulation affecting the use of land, including some of the land restrictions in Title 10. So the current state of things is that the lister handbook, the training that PBR does, it all is to inform listers and assessors to take into account these restrictions on development. We know that there's inconsistency from municipality to municipality because there's different individuals doing these things. A one thing I'm curious about is whether there was one instance of maybe that not being taken into account enough. Or if there's a particular fact pattern that exists in which maybe, PBR can be asked to do some further instruction with people or something like that.
One question, Kirby, is when you have a situation in which you have the property has been sold recently, isn't the fair market value the price, at least taking into consideration the price that it's sold at?
They're, the listers and assessors are trained to not chase sales.
Mhm.
Because, they're supposed to use the same consistent process for.
Mhm.
So it starts to be inequitable when you chase a sale
Sure.
that doesn't match your process. So it's more important to follow a same consistent process to have equity within the town
Mhm.
than to do that.
Even though, for example, you have enough sales that it's evident that the listers are wrong.
I mean, sometimes that comes into play in appeals and things. The equalization study also, it does use sales, when that happens. So that's probably in CLA's determined.
I was just gonna say, and also on appeal, if a property is appraised at a value that the owner thinks is too much because they have restrictions on part of their property and what they can use, they can take that up in appeal already for current law.
Yes, that's true. I tend to try to advise to be as efficient as possible though with the tax code and, you
Yeah.
know, appeals, like if people are having to go through appeals in order to make the process work, then, you know, that's not.
Yeah,
Yeah.
for sure, but
Yeah,
Well, I just ran into this, Board of Civil Authority, for example, in Swanton, where people were appealing the issue of, I have all this wetland here. What am I going to do with it? And why is it so high? And what the board typically did was follow the advice of the listers and so on. And the person then appeals to the next level and wait. Got increasing couple of significant cases of that pending right now. I'm just curious how the state, the highest appeal level, deals with that. Because people are saying, I can't use this land because it's wet, it's underwater, I can't plant on it, I can't do it, I can't even walk on it. And yet you tell me it's worth X number of dollars per acre.
I know this, sometimes these appeals can come down to competing experts, the evaluation experts on each side. And then I find it a little bit humorous. Sometimes if it isn't up in trial court, you have a judge who's not an expert in evaluation making the call. But it's which experts they believe or which,
I think listers are more of a science. If you go to a realtor, they'll do a market appraisal for you, or market study. That will be based on similar homes and the sale price.
yeah,
And you'll get what the list, what the realtor thinks your house will sell for, which is frequently different than what an appraiser says your house is valued at. The bank wants to know what the appraiser says because they need to protect their mortgage. There's more of a structure and a science, whereas
yeah. When I was saying what the listers do with art earlier, I was just getting at the like flexibility and the interpretation of sometimes things having to take place. But yes, they certainly follow. Like there's a land schedule for the town that they use, and there's formulaic aspects to it.
and there are professional listers, and then there are towns who just have a board of listers and your boards of civil authority, who usually is the first appeal, know nothing.
But yeah, but with at least qualified people to make a judgment.
Having
We're called on to.
done many
deal
of
with the
them,
appeals.
having no idea. Many years ago, when I think a third of the appraisals at Montpelier were appealed. About dogs and cats out. And it was an interesting year, but we're coming a long way in getting our listers up to a more professional level, but we aren't there yet.
So that was background to say that, Senator Hefferna's concern is in the law. I'm not saying that it's being apply correctly everywhere, and not saying there's not a problem. But what we put together to resolve, his request was to add a section also within the property valuation sections law. Saying that parcels with wetlands shall be listed and taxed on the same basis as other real estate, provided the assessing official accounts for any reduction in value of the parcel due to development or use restrictions caused by state and municipal law. That's very similar to what we read before. This one is just specific to wetlands. And it does do a little bit more in defining what wetlands are based off of state law. But I would say that this does overlap basically entirely with what we already read before. If you did want to move forward with this more specific provision, it would probably be a good idea to have me add a provision that this is intended to work with the other provision, as opposed you wouldn't want a court to ever be in a position to think there's two different provisions that say kind of the same thing, and then for them to try to interpret a reason for that. So to be clear that, that one of these isn't meant to contradict the other, I think would be important.
We might just want to strike the one that's there and put the new one in if we decide
The other one's more broad.
it's more broad.
Yeah, so that one, for instance, Act 250.
That's right,
all-
Eddie.
Yeah,
Got it. Yeah. But this one is specifically for wetlands. And kind of puts a magnifying glass or almost like a footnote on the existing law.
Yeah.
When we say wetlands, this is what we mean.
it provides some additional ways for a lister assessor to identify what is a wetland by indicating, by defining them. But that's mostly what it does beyond what already exists.
Okay. That's it.
So,
Committee questions. All right. I think you've got great.
Okay, great, Madam Chair. Just.
That's great. We have great. 3:00, we're gonna do S 208. Be back